Hello, this is Mark Workmeister with Professional Financial Advisors. Today I'm going to start what I hope is a monthly video series on which we can go over some of the data, some of the interesting charts from the markets and from just the economic, political standpoint that we get every month as advisors. And so I'm just going to try and go over a few slides every month that I share with the general public that I think you might find interesting. So like I said, we get a lot of data we look at that you're looking under the hood a little bit that people probably don't pay too much attention to, but it's still interesting nonetheless. So we're just going to take a few minutes and share some of these slides and kind of go over them and show you what's going on and our interpretation of them. And I hope you find some value in it. So I'm going to screen share here. I'm going to go over these chart packs, and we get these charts from all kinds of companies. JP Morgan has a big one. State Street is the one we're going to look at today. So to start with, I'm just going to look at the equity slide. So I have 3 slides. I'm going to look at kind of the market rebound from last year, and we're going to kind of look at active money managers versus index funds, how they did last year, and then we're going to look at the fixed income space and kind of the challenge they're going forward with owning bonds. So this chart, if you see it, it really is just looking at the market rebound from the bottom to the top last year. So it's not taking into account the drop that happened in March due to COVID. It's just looking at the bottom and then how all of the asset classes listed here return. So just to kind of reinforce, it's always easy with hindsight, but to kind of reinforce why when those things happen, it's really tough to sell. If you don't get out before all of this happens, it's almost too late. And we'll show you why, because these really turn into really giant opportunities as opposed to getting out after the market's dropped. So just a quick look so we can see from bottom, mid caps rallied the most. So mid caps rallied 86% off of their 52-week lows last year. So from the low to the high, 86% gains. Small cap 80%, emerging markets 67%, US large cap 65%, international 58%. The only thing that really didn't rally much was the dollar. Mortgage-backed securities didn't rally too much. Treasuries, they were going up the whole time, but you can still see they rallied 8% from their low. So really every single asset class rallied last year off of the low. So take that into account. And then we look at each year, we're always evaluating active versus passive money management. So passive money management to us is index funds. And you can have a whole bunch of different index funds, it doesn't have just to be the S&P 500, but the idea of should we just follow a static index with lower fees, or should we look to a professional money manager who's going to pick stocks for us? So this shows us how the professional stock pickers did last year as measured by State Street. And you can see these first 3 here. So large growth, mid growth, small growth. Those managers in those spaces, 62% of the managers outperformed their benchmark, 58 on mid cap, 67 on small growth. And then the rest of them, the majority did not. They were not able to beat their benchmark. And this is consistent in the fact that most of the time, I'd say the majority of these asset classes do not outperform their benchmark. It's different every year. So last year, the growth managers did really well. So the growth stocks are companies that are taking their dividends, they're reinvesting, they're really trying to grow the company versus a value company that, you're more focused on price. So you're trying to find a quality company that is maybe underpriced. So you're looking at that price per value equation as opposed to just how much is the company going to grow going forward. And we've seen, so if you look down here, the excess return was pretty good. Growth managers were outperforming their benchmark from 6 to 8% in these 3 different asset classes. On the downside, the ones who underperformed were underperforming from 2 to 4%. So just a little look last year. Anybody that works with us or follows us knows that for the most part, we prefer passive index investing. And the reason is, it takes out a lot of this underperformance and a little bit of the guessing game trying to choose managers. The next thing that I think is really interesting is kind of the look at bonds going forward and the challenge that we have. So this shows what the 10-year yield is, this dark blue line going back to last January, and we can see how it's dropped. And then it looks at what the break even is as compared to inflation. So how much does the yield have to, where does the yield have to be in order just to break even with inflation? So the 2-year break even. So you can see that when rates really dropped last March and April, you would have had to have deflation, meaning the inflation would have been -1% just to break even on that bond. And so in the 10-year, it wasn't quite as bad, but still, you would have had to have 0.5% inflation per year. That's not very much to break even on your bonds. So right now, we're about 2%. So we need a 2% yield on 2 and 10-year bonds to break even just with inflation. So if we're not getting a 2% yield, we're probably going to go backwards with inflation. That's kind of what we're looking at here. And so you can see right now, we're not quite that high. This other chart, I'm not going to spend as much time on, but it's really the spread. We've seen some pretty historic spreads between the 2 and the 10-year last year. So basically it's showing the difference in the rate of return you would get from buying a 10-year treasury versus a 2-year treasury. And the spread, you can see there's, so it went really high and then it started going down and now it's starting to go back up here. So takeaway on the bond side is just that, it's still a good non-correlated asset to hold against your stocks. So it's a good diversifier. But if you're just buying a bond on its own merit, we're in an inflationary environment, it's going to be pretty tough to come out ahead on that. And then on the stocks, once again, market rebound, things that go down, come up. And if you're getting out at the bottom of the market, you're missing out on some of these historic pullbacks. And then, on the index passive, not really a takeaway here, just showing you how it was last year. This changes every year. Sometimes the active stock pickers do better, sometimes the passive. But over time, usually the cheaper option, in our opinion, comes out in the green. Thanks for listening. Hopefully it was short and brief. Hopefully you found it entertaining and found some value. And we will try and do this again in a month. So thank you very much.